Welcome back, everyone. Tax Burson CPA here today, and we're going to talk about the pass-through entity tax, or short you may hear the PTE tax. Now, first of all, because I respect your time, if you do not own an S Corp or a partnership or are not going to start one in the next year, probably not worth your time to stick around for this. Catch our next video. That's going to be more on tax updates and tax planning strategies that you can still do this year. But if you do have a small business and an S or a partnership, stay tuned. Okay, so I want to give you a little background on why the pass-through entity tax is even something we're discussing. This goes back to 2018, and if you remember in the Tax Cuts and Jobs Act, they pretty much doubled the standard deduction, and they also put a limit on the amount of state and local tax you can deduct. They call it the SALT tax, state and local tax, and that cap was $10,000. So if you have more than $10,000 or you don't have enough to itemize at all, you don't get to deduct your state taxes and get that deduction. And that stinks. And if you're in a high tax state such as New York, it can stink a lot. But even here, real estate taxes have continued to climb, and with inflation, etc., there are more and more people who are getting hit by this. And so now we have a way in Missouri and Kansas to where we can actually get you that deduction back. But it's not so simple, and to be honest, the forms aren't even released yet, but there are some workarounds, and we're going to talk through that. Okay, let's think about this simplistically. The way this works is if you have $100,000 of income in your entity, and this is a key point, it has to be an entity, it has to be an S Corp or a partnership. Everything else is not what this is about. This is pass-through entities. S Corp or partnership. And what you're going to do is you're going to pay the tax through your entity. So what's this look like? $100,000. The PTE tax, pass-through entity tax, for Missouri will be $5,200. I believe it's 5.2%. Kansas is 5.7%. So you would pay in roughly $5,500 in either state with your corporate tax return. Then on your personal tax return, you would get a credit for your share of that $5,500 to offset your state tax on your personal return. So it flows through to you based on your ownership percentage. So if it was $5,500 and you have 50-50 partners, you're both going to get $2,250 as a credit on your personal tax return. However, you are a tax basis, a cash basis taxpayer, and the IRS, it's been deemed on this particular deal, in order for you to get a deduction on your federal return, you need to pay that in by the end of the year. That means we have basically 3 weeks, and you've got to pay this in as an estimated tax payment. And I want to be real clear here, it depends on your state. There's a lot of different rules. Right now, Kansas and Missouri, because this is so new, they're trying to work out their rules. Kansas right now, your only option is going to be to send it in with a Kansas 1120 or 1065 estimated tax payment, and then you should write across the top of it, and Missouri's given specific language. Let me go find that real quick for you. Missouri says right across the top, pass-through entity anticipated tax payment, because that makes things simple. Right. Pass-through entity anticipated tax payment. I'm going to assume, and we know what that means, but that Kansas, that's going to be the best way to do it too. Missouri then goes on to say they're developing a specific coupon for this tax, and they will have it at some point this month, which means they don't have it yet, and I'm not going to hold my breath and wait till the very last second. So if that comes out, great. Kansas has not said that yet anywhere that I can find, and so I think if we do just like Missouri says here, right across the top, we should be covered, especially this first year. Okay, so that's wonderful. We can actually pay our tax in. Let's think about the implications of this. If I paid $5,500 into the PTE estimated tax payment, I did it on time, so I get the deduction this year. What does that look like? Well, one, that means we don't have to worry about the SALT tax limits because now it is a federal deduction. So we get the deduction at the federal level. Depending on your income tax bracket, most of you are going to be between 15 and 24%. So we'll just kind of go somewhere in the middle and call it 20%. You're going to get basically, depending on your state, $1,100, $1,200 of tax savings if your business profit is $100,000. So this is real money. If your business is $200,000, do the math, right? $500,000, we're really starting to make a dent. But if your business is below $100,000, I really don't think it's worth all the effort to try to do this because there's several ways this can backfire. One, you had a net operating loss from the year before, and so you're not going to have any state tax anyway. Two, you have other things going on that it's going to offset. Maybe you have losses from another business. Maybe, especially in Missouri, there's some really cool credits that you can do with certain charities. We'll talk about that in a different video. Talked about it last year, actually. If you have this other credit going on, then we don't have any taxes to offset. And the downside to this is not a refundable credit. So if you pay $5,000 in through your S Corp, you go to do your personal tax return, you don't have $5,000 of taxes, you don't get to get that money back this year. It's not lost, it rolls forward into the future years, but we don't get that money back this year. So we really need to think this through. If you want us to look at this in detail for you, we can do that. I only have so much time, and there will, of course, be a fee. But if your return is pretty simple and you're comfortable, you can look at last year's tax return, see how much your state tax was, just compare that to how you're doing this year, and take a ballpark stab at an estimate. You don't have to get it exact. I'd probably go a little low just to give myself some cushion. And then when we do the tax return, everything is wonderful. But I wanted you guys to know about this because there's some confusion here with some other accountants that I've heard about that don't think this goes into effect until next year. But if you read the bill specifically, what it says, and actually let me pull that up. Okay, here we have it, Missouri House Bill number 2400. And I believe it was law page 27. There it is, line 144. The provisions of this section only apply to tax years ending on or after December 31st, 2022. And some people have missed that word right there, years ending on. Years ending on December 31st, 2022 include 2022. So that takes care of that. Kansas is similar. It does go into effect for this year, and I wanted you guys to see that so that if you get some differing information, because there is different stuff on the internet, unfortunately anybody can say anything they want on the internet, and well, enough about that. Okay, so back to where we were. All right, so here we are on the Missouri Department of Revenue. We're going to go through this one real quick because Kansas does not yet have one out. Can't say for sure, but based on experience and talking with other preparers around the country that have had this for a couple years in their state, Missouri and Kansas were a little later to get to it, but we're definitely ahead of a lot of other states. There's a lot of states that still haven't, but I expect it to be pretty similar. So let's just go through this real quick on the FAQs. I think I'm giving you enough information. How will I file it? You file it with your S Corp or your partnership return. And like I've already told you, they're still working on developing these specific forms, so we may not see them till the very end of the year, and we won't have time at that point. So I want you guys to know about it. But we'll file this with your corporate return, but you're going to need to have made the estimate in advance. But technically, the PTE form is not due until essentially the same time you file your S Corp or your partnership return, unless you filed an extension, and once again, this goes along with it. But as we said earlier, if you don't pay for it within the calendar year, yes, it'll be deductible, but it'll be deductible in the year you pay it, so you wouldn't get it until next year. So don't get confused on that. We need to do it by the end of the year. What is the tax rate? Already covered that, 5.3. Kansas is 5.7. So pretty close to the same. That's just different tax rates. How do you claim it? Well, you're going to get a MOTC form that's going to come from your entity, your S Corp or your partnership, and that is how we're going to get the credit on your personal tax return. So we pay it at the corporate level or the partnership level, and then based on your ownership, you get to get a credit on your return. What we can't do is say, hey, I've got two partners, me and Joe. Joe owes $8,000 on estate tax. I owe $2,000. We're 50-50 partners. I'm going to give Joe 8 and I'm going to take 2 and we'll pay 10 in. It doesn't work that way. Whatever you pay in is going to get allocated based on your ownership percentage. And until they say something different, I don't want you thinking you can do that. So that's where, if you got multiple partners, we may just pick a number that we feel is fair and go ahead and pay that in. Are you required to pay an estimated tax? The FAQ says no. And it's right, but if you want to deduct it this year, that's not true. You need to pay it in the calendar year. We've seen that in multiple other states already, so I think we can say that pretty safely. The IRS is not going to let you have that deduction except for the year that you pay it. How can we pay it? That's using the 1120 ES statements. We've talked about that. Those need to be done by the end of the year. Keep your ears out. There will be a form coming, hopefully, but if not, do it like I told you earlier. What if you have out-of-state partners or shareholders? That is okay. They will still get credit for it. And I believe if you read Kansas says if that's the only income they have, actually Kansas doesn't say that. That's Missouri. We're still waiting on information from Kansas. So I don't know if this is true for Kansas. But Missouri says, hey, if this is the only Missouri income you have, you're an out-of-state shareholder, and this is it, and we've done the PTE tax, you're off the hook. You don't have to file a Missouri return. Your filing requirement has been fulfilled. So for some of you, that could simplify your life. You have to look at that individually and see if that makes the most sense for you or not. But that could be a benefit for some of you. Okay, what if I'm a partner or a shareholder in an S Corp that has income from another state and that state has a similar program? Will I get credit in Missouri for that other state? And the simple answer is yes. Don't have any instructions, but I'm assuming Kansas will do the same thing. We'll have to wait and see, but I would expect so. I don't see a reason why they wouldn't. They're doing this obviously to benefit small business owners, to give them their deductions back. So clearly this is intended to benefit small business owners, not ticky-tacky them to death. So that's that. I think that covers everything. We could beat this thing to death, but if your income's under $100,000, simple answer, yeah, you'll save taxes, but it may not be worth your time. You'll have to make that decision. Income's above $100,000, look at last year's tax liability. Think about any other credits or NOLs you may have. Does this make sense for you? If your income is substantially higher, it may behoove you to give us a call and ask us to run calculations for you. to see if it makes sense, because this could be, if you're making 500,000, this could be a huge tax savings for you, and definitely is something you don't want to miss. So hopefully that explains a lot of this and helps you out. If you have any more questions, let us know. Drop them down below. I'll try to answer those that way, because if you had a question, there's probably others, and we want to make sure that we're helping you guys the best we can. I know we only have 3 weeks. We're doing the best we can on this. Like I said, a lot of firms have decided to punt. There's just not enough time to deal with it. But I want you guys to make that decision. I don't want to make it for you. So hopefully this is helpful. Stay tuned. We're also going to start covering some year-end tax planning for individuals. We've done a lot of that in prior years. So most of that, very similar income, expense bunching. A lot of that stuff is good. Go ahead and take a look at those prior videos. That'll get you up to speed, and I'll try to get something out current in the next week as well. Talk to you later. I just did a big open circle.